Welcome to this comprehensive introduction to day trading options. If you're new to trading or just getting started, you're in the right place. In this video, we'll break down the fundamental concepts you need to understand to day trade options, such as calls and puts, the Greeks, key terms, and more advanced topics like derivatives and futures. I personally wish that I had come across this kind of video when I was just starting out, so I decided to make this kind of video and hopefully it'd be helpful for a beginner just starting out. By the end of this video, my goal is that you'll have a solid understanding of what options are and how to start trading them. Options are financial contracts that give you the right but not the obligation to buy or sell an underlying asset, typically a stock, at a specific price called the strike price, all before a certain expiration date. Unlike stocks where you own a part of the company when you're buying shares, an option is a derivative. This just means that its value is derived from the price movement of something else, in this case the underlying stock. Buying calls and puts. A call option gives you the right to buy the underlying asset at the strike price before the option expires. If you expect the stock's price to go up, you might buy a call option, and this way you can capitalize on the stock price movement without having to own any shares. For example, let's say stock ABC is trading at $100. You buy a call option with a strike price of $105, expiring in 1 month. If ABC's price rises above $105, your call option will increase in value. Why? Because you have the right to buy the stock at a lower price than the current market price. If the stock's price rises to $110, you can either exercise the option and buy the stock at 105, or you can sell the option itself for a profit. On the other hand, a put option gives you the right to sell the underlying asset at the strike price before the option expires. You would buy a put option if you think that the stock's price is going to go down. For example, let's say stock XYZ is trading at $100 per share and you think that the stock price is going to go down, then you would buy a put option, maybe at a strike price of $95. If XYZ's price drops below $95, your put option increases in value. You now have the right to sell the stock at a price of $95 when the current market price is lower, say $90. You can either sell the stock at the higher strike price or sell the option for a profit. Most day traders like myself are usually just buying the option contracts and then selling it later for a profit. Again, simply put, if you think the stock's price is gonna go up, you buy a call option. If you think that it's going to go down, you buy a put option. Now that you know the basics of a call and put, let's go over some key terms you'll encounter in options trading. The strike price is the price at which you can buy or sell the underlying asset when exercising an option. The expiration date is self-explanatory. It's the date by which the option must be exercised or it will expire worthless. The premium is the price you pay to purchase an option. This price is influenced by several factors, including the stock price, the strike price, time to expiration, and market volatility. The intrinsic value is the difference between the stock price and the strike price, assuming the option is profitable. For instance, if a stock is trading at $110 and you own a call option with a $100 strike price, the option's intrinsic value is $10. The extrinsic value is a portion of the option's price that isn't explained by intrinsic value. This is also known as time value, as it reflects the potential for the stock to move in your favor before the option expires. A call option is in the money when the stock price is above the strike price. A put option is in the money when the stock price is below the strike price. A call option is out of the money when the stock price is below the strike price, and a put option is out of the money when the stock price is above a strike price. Honestly, when you're day trading, you may take a glance at all of these, but what you really need to focus on, in my opinion, is the strike price, the expiration, and the premium. Depending on how long you'll think the trade will last, you'll choose the expiration date accordingly. When trading options, you'll often hear traders talking about the Greeks. These are just a set of measurements that help you understand how different factors influence the price of an option. The 5 most important Greeks are delta, gamma, theta, vega, and rho. Delta measures how much the price of an option will move relative to a $1 move in the price of the underlying stock. For example, a delta of 0.5 means that if the stock price moves up by $1, then the option will increase in value by 50 cents. Delta for call options are positive, while deltas for put options are negative. So for me, when I'm trading options, the delta that I usually choose is usually anywhere from 0.3 to 0.6. The higher the delta, the more volatile and riskier the contract contract is. Gamma measures the rate of change in delta. It tells you how much delta will change if the underlying stock moves by $1. Gamma is important because it shows how stable your delta is. If the gamma is high, the delta can change quickly, making your option price more sensitive to stock price movements. Theta measures the time decay of an option's price. As options get closer to expiration, they lose value due to the passage of time. This loss in value is reflected by theta. For example, a theta of negative 0.05 means that the option loses 5 cents in value every day, all else being equal. Honestly, you should just try to be aware of the concept of theta and not trying to calculate in real time when you're trading options, what it will do to your option value, especially when you're trading short-term expiration dates. Same for these last two, Vega and Rho. You should just understand the concept of what they are, but you won't need to be calculating in real time as you're trading options. So Vega measures the sensitivity of an option's price to the changes in volatility of the underlying stock. If volatility increases, options price generally rise, and if volatility decreases, then options price usually fall. Vega is crucial in earnings season or during market events where volatility tends to spike. Rho measures how sensitive an options price is to changes in interest rates. This is less relevant for day traders and more relevant and important when dealing with long-term options. Honestly, this may all have sounded like gibberish to you, but what I really want you to take away is the concept of delta and theta. Just know how volatile your option contract will be when the stock price moves up or down by $1, and how your option will lose value over time as it comes closer to your expiration date. So you should just try to understand what the relationship is between the intrinsic and extrinsic value when it comes to day trading options. As mentioned earlier, the intrinsic value is the difference between the stock price and the strike price, but only if the option is in the money. It represents the financial benefit of owning the option. Extrinsic value is the premium you pay for potential future gains. The more time until expiration, the higher the extrinsic value because you have more time for the stock price to move in your favor. When day trading, you'll typically deal with options that have little time until expiration, which means their prices are heavily influenced by extrinsic value or time decay. Volatility is super important when it comes to options trading. The higher the volatility, the more expensive the options. Why? Because the higher volatility increases the chances that the stocks will make a big move, which in turn could make your option more profitable. There are two types of volatility for you to consider. HV, or historical volatility, measures how much the stock has fluctuated in the past. IV, or implied volatility, reflects the market's expectations for future volatility and is baked into the price of the option. When the IV is high, the option premiums are higher. When you're day trading, you should just be interested in the IV because it tells you whether the options are currently expensive or cheap relative to the historical norms. The IV tends to get higher when the company reports earnings. Options are a type of derivative, which means that their value is derived from the underlying stock or asset. Other types of derivatives include futures and swaps. Here's a brief explanation of what futures are and their role in day trading. Futures are contracts to buy or sell an underlying asset at a predetermined price at a specified time in the future. They're commonly used in the commodities markets like gold or oil, but you can also trade stock index futures. In contrast to options, futures contracts obligate you to buy or sell the asset at the expiration date. Options on future contracts are also available for day traders to speculate on price movements on commodities or stock indexes. You can find stock market index futures such as the S&P 500 futures, which is the ticker symbol /ES, and NASDAQ futures, which is the ticker symbol /NQ. Key strategies for day trading options. When day trading options, you'll want to focus on strategies that will allow you to capitalize on short-term price movements. Here's a few common strategies. Buying calls and puts. Buying calls and puts is the simplest strategy, and this is where you buy a call option if you think that the stock price is going to go up, and where you buy a put option if you think it's going to go down. This approach requires you to be correct both on the direction of the stock and the timing. The timing is important because you have to take note of the theta or time decay of an option. Scalping is a strategy where you make quick small profits by taking advantage of tiny price movements. Since option prices can be very volatile, scalping allows you to profit from rapid intraday moves. While day traders typically buy options, some advanced traders will sell options or sell premiums to capitalize on time decay and IV drops. This can be a riskier strategy and usually requires more experience. I personally don't sell any options options, I usually just buy calls and puts, but honestly it's all up to you and what you think that you'll profit most from. In conclusion, options trading offers an exciting way to profit from stock market movements without having to buy shares or stock of a company. It requires less money to earn a decent return on your money because these options are leveraged. One option contract equals 100 shares of a stock, and you can usually buy a premium of one contract for a couple $100 depending on the stock. So hopefully you got an understanding of what calls and puts are, what the Greeks are, and what the impact of volatility is, so that you can take advantage of the stock market and hopefully make a decent profit. If you're just starting out and interested in making money from the stock market by trading, I'll highly recommend you to fully understand the game and practice by paper trading. Brokerages nowadays such as Thinkorswim or Interactive Brokers, which is what I usually use, offers both real and paper trading platforms. I'll just hop on the paper trading platform and just get a feel for how to execute orders, what the layout looks like, what the options chain looks like, where to find the deltas and thetas, and overall just get a feel for it. Then I'll start with a minimal amount of money, anywhere from $100 to a couple $1,000. You do want to be learning with some money and some emotions on the line, because trading psychology and managing your emotions while you're trading is a huge component of trading. With paper trading, there's obviously no emotion involved, and honestly, it's not really helpful to do that for the long term. Again, I'll just try to get a solid understanding of the layout of the platform with fake money, and then hop onto the real trading platform with little money. I personally started with $5,000, but to each their own. You guys all have your own personal situations regarding your finances, and so whatever suits you best. Thanks for watching. I hope you learned something valuable in this video. If you did, smash that like and subscribe button. I recommend you guys to watch my other videos if you guys haven't, and if you already did, I'll catch you in the next one.